What's up, guys? September's here. It's typically not a very good month for the stock market. So let's look for some stocks that we think are attractive at these prices and lower for long-term investors to dollar cost average. Today, we're gonna look at 10 dividend stocks that I think are attractive here and lower. What's cool about this list, guys, there's gonna be a handful of stocks that are my favorite dividend stocks in the whole world. There's gonna be a handful of stocks on here that we've never talked about on the channel that you've probably never even heard of before. So you're gonna wanna check these out. So the first one is Home Depot. They're not in any particular order. And I will say off the bat that this is one that could have some more pressure if we go into a recessionary period or if we have a housing crisis. But with that said, guys, this stock was $421 on December 6, 2021. It's come down. The low is $264.51 June 22nd. So it's a little bit off those lows, but a lot of this might be priced in already. The nice thing about dividend investing, of course, is you get paid to wait. So if you're a long-term investor, you're looking for some income, you're looking for some stocks to get into. Now I'm gonna show you the price levels on each of these stocks that I think are attractive. This one fits in that DGI, DGIF type hybrid. I've had this stock for a long time. If you look at this thing, it pays about a 2.6% dividend yield. It's a mega cap, $300 billion. It's an 18P ratio. I think the stock could go a little bit lower. Looking at a chart, it looks like $265, $269 is possible. I would dollar cost average on this one, $265 to $285. The next stock is Broadcom. Now, they actually reported earnings last night. Very solid earnings. Beat on the top and bottom lines. They also raised guidance. They have something like $8.5 billion cash and cash equivalents sitting around in the bank. This is a very strong company, and they're looking to acquire VMware, which I think would be a very strategic acquisition. It is a little bit expensive, and that's part of the reason why the stock's been hit a little bit. It was a $677 stock here, December 28th. The low was July 5th at $463. Considering we've got a nice earnings report since then, below $500, dollar cost average. I think it could go as low as maybe $450 if the market gets really crazy, especially if semiconductors keep selling off. The thing about this thing is a 24P ratio, so a little bit maybe expensive, but it pays you a 3.3% dividend yield. Now, I think a lot of people don't realize what Broadcom all touches. They do a lot. They're in networking when you think of high performance connectivity. So enterprise, service provider, hyperscale data center. They also have server and storage connectivity, so for on-premises and cloud. So enterprise and hyperscale data centers. They also do end-to-end solutions, so connected devices, Internet of Things, customer premise, service provider. They do a lot of different stuff here. Wireless, think of 5G, mobile connectivity. Also industrial automation. So you think of robotics, you think of autonomous vehicles, you think of renewable energy. These guys have their hands in a lot of pots, and it's a nice technology company that's not crazy expensive. Nice dividend yield. I like this one, guys. Broadcom, ticker AVGO. Next on the list is Comcast. Now, I understand why you might not be crazy bullish about something like Comcast, because the first thing you're going to think of is cable, broadband cable. And if you've had them before, you might not love the experience. These guys own a lot more than that. You look at this, they own everything from cable communications, media studios, theme parks, Sky segments, on and on and on. You got NBC Universal, so you've got Peacock streaming. Now this stock, what's notable about this stock, guys, is when it gets to $35 and under, it's going to be over a 3% dividend yield. That's the highest the dividend yield has ever been for this stock. A 12 PE ratio paying you right now a 2.93% dividend yield. Large cap, $162 billion. This is a quality company. I think if it gets much lower, between say $30 and $35, this would be a good one to add, especially for a DGI investor, someone that's looking for some income. It's a stable company. It should continue to do well. And it's, basically 50% of the high is pretty much the lowest it's been. The high was September 3rd, $61.80. The low on this, August 30th, $35.61. And guess what? Today it's $35.74. So under $35 dollar cost average, a nice 3% dividend yield, Comcast. Okay, so this one we definitely have never talked about on the channel. Now, this is not Marriott like MAR. This is Marriott Vacations Worldwide, ticker is VAC. So it's a vacation company. It develops, markets, sells, and manages vacation ownership and related products, operates through two primary segments, vacation ownership and exchange and third-party management. So you have things on here. You've got Grand Residence by Marriott, Sheraton Vacation Club, Westin Vacation Club, Hyatt Residence Club. Now, I understand if we go into a recession, something like this could get impacted. The way I'm looking at this, though, I don't want to buy at these prices. I want to buy it a little bit lower. So on my notes here, I've got target 130 or under. Right now it's $138, so it needs to come down a little bit. $130 or under dollar cost average. That would put you at about a 23P ratio, a 1.8% plus dividend yield. This is a smaller cap, guys. It's less than $6 billion. It does have some short interest right now at 6.45%. And it's the low is $110 June 23rd. That was probably a decent opportunity. 174 is the high on January 7th. So I think this needs to come down a little bit. I'd like to see it $130 or less, especially if it got down to 110. So dollar cost average 130 or under. This one is VAC. One of my favorite DGIF stocks, dividend growth investing for FIRED, where there's going to be capital appreciation on the stock as well as increasing dividends. It's going to be Tractor Supply Company. Now, I think that this stock is attractive here, but I'd like to see it a little bit lower. 175 or less, dollar cost average. Pays you a 2% dividend yield or so. It's got a 20 P ratio, 21 right now. It's a mid cap, $20 billion. You can see it was a $241 stock on March 31st, 2022 this year. Came down on May 25th to $166. I think it gets really attractive when it gets in that range. So say 165 to 175 dollar cost average if it gets that low. Tractor Supply Company, I think these guys have a pretty strong moat when you look at where the locations are and who the customers are. A lot of these locations are very strategically placed where there's not a lot of other options, not a lot of opportunity to go elsewhere. So a lot of people want to try to compare it to other things like Home Depot. Tractor Supply Company, when you first hear it, you think of, tractor parts. And of course it caters to that, but it has so much more from, pet food, even pet veterinary services. It's got clothing, it's got camping supplies, it's got gardening supplies. It's really a very unique retailer. There's nothing really else like it. And the way I explain it is they're kind of in the third tier suburbs. So you think of Minneapolis, because I used to live in Minneapolis. Minneapolis, you're going to have your Home Depots and your Lowe's. Those are going to be, kind of where the suburbs are. The Tractor Supply Companies are going to be a little bit further out, where they're close enough where the people that live in those suburbs of the cities can still drive out a little further into the rural areas. And it's also close enough where the rural population can get there and not have to go all the way into the suburbs or into the actual city. So I like this one a lot, guys. I like the management a lot. I've covered this one for a while. Tractor Supply Company, TSCO. All right, so where are my income investors at? Because this is a 6% plus dividend yield, 6.12%. This is Verizon. Now, this is not going to give you growth, okay? So if you're a young investor, this might not be the right stock for you. This is one of those great passive income type stocks that's pretty safe. It's a solid company. It's basically utility, and you're going to keep getting that dividend 6%. The PE ratio is 8.4. It's actually at lows right now for the 52 weeks. So September 2nd, it's at a low right now, $41.26. The low was $41.15 today. The high on this was $55.51 on April 22nd. I think the upside here is very positive for something like Verizon with a 6% dividend yield, an 8.5 PE ratio. Check out Verizon if you're looking for some income. So back to semiconductors, and while we're talking about semis, guys, there are a lot of semiconductors that I think are opportunities at these prices and lower. Now, the whole segment's going to get hit, and historically, the market likes to look at semiconductors as something that's very cyclical. Now, I think that it's becoming less and less cyclical, because if you think about it, semiconductors are in everything. You've heard me say this before. They're the new oil. From this microphone, the computer, the TV, everything you see as microchips has semiconductors. A lot of the new vehicles have hundreds of semiconductor pieces of equipment in those, especially the autonomous, right? So you're going to see more and more of this. Now, KLA, you can look at like Lam Research, Applied Materials. This is one of those semiconductor equipment manufacturers. Now, this is a 15 P ratio, which I think is very attractive for the growth. It pays a 1.54% dividend yield. This is going to fit in the DGIF bucket. I think it's best of breed when you think of the semiconductor manufacturers. I also like ASML, but KLA is the one that came up with my screener. All these stocks came up in a very detailed screener with thousands of stocks, and this come up as opportunity to add at these levels and lower. Now, you do need to note that 282 was the low on KLA, and sometimes I say CLA, so if I say that, forgive me, it's KLA, CLAC. The low on this was July 5th, $282. It was up to $457 on January 13th, 2022. So it could go a little bit lower. 1.5% dividend or so. It's a DGIF, 15 P ratio. My target for this, guys, $325 or less dollar cost average. Of course, it could go below $300. I think it's very attractive if it gets below $300 again. Check this one out. Now, I've got a few more stocks, so do stay tuned. Before we go on, I want to announce this video is sponsored by The Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. And if this video is helpful, please drop me a like and drop me a comment. If you're new to the channel, click that subscribe button, click that bell to get notifications. Now, financials have been hit really hard, and there's probably several different banks that you could look at. I know that you might not be a big fan of financials. This is one that you've probably never heard of before. It's probably never been on YouTube before. It's a small cap, $4.59 billion. I don't know a whole lot about this. It came up on the screener. I dug in a little bit, just spent a little bit of time, and it looked interesting enough to bring it to you. None of these are, stocks that you should just go run out and buy without doing your own homework, your own due diligence. I'm just bringing 10 stock ideas to you. I'm not your financial advisor. Make your own decisions. But this, guys, pays a 3.5% dividend. It's under a 15P ratio, small cap, $4.59 billion, $25 a share. And what this is, of course, is a bank. It looks like mostly in the South, Midwest, and Texas. So Cadence Bank provides commercial banking and financial services in the United States. So it has consumer banking, consumer loans, mortgages, home equity lines of credit. And you can look at this and say, I don't want to touch financials, especially banks, because people are going to start defaulting. That's something you want to dig into a little bit more. But it's hard to ignore this, the 3.5% dividend in a 15P ratio. The growth metrics were very positive that came up on the screener. There was only a couple banks that came up on that screener, and this is one of them. So another hospitality name here. This is Vail Resorts. The ticker is MTN. All right. Now this one's going to be the most expensive stock on the list, but it has some really nice growth on it compared to some of the other stocks as well. Now, if you look at this, it's about a 29P ratio. So I would want this to come down a little bit. It does pay a 3.4% dividend yield. It's about a $9 billion market cap. $205 or less is where I target this. So I would not pay $222. I would need it to come down closer to $200, around $205. Is where I target for this one. Just real quick, if you're not familiar, so Vail Resorts operates mountain resorts and urban ski areas in the United States. Now, when you look at both of the hospitality stocks that we're talking about today, they're gonna be that higher end consumer that's maybe less impacted from inflation and maybe from a recessionary type environment. So that's what I'm targeting here. I'm not saying they're bulletproof by any means, but when I think of people that go to Vail Resorts in the winter, they're probably gonna go skiing, whether we're in a recession or not. And maybe my assumption's inaccurate, of course, if the recession gets really hardcore. But so far, what we've seen from the consumer is that the high-end consumer has not really been impacted nearly as much as the rest of the U.S. consumer or the economy as a whole. So I think this one could hold up. And again, I'd want the price to come down a little bit, closer to $205 or less. The last one's probably my favorite income stock. It's a DGI / income type stock. It pays you a 4% dividend. It's under a 20P ratio right now. AbbVie, okay, $136.28 right now. I think 135 or under DCA. Again, it's a 20P ratio, 4% plus dividend yield. It's paying a 4.07% dividend yield. Mega cap, $244 billion. Now, if you're looking for some growth stocks, guys, I just did a video 2 days ago, top 5 growth stocks that I like at these levels and lower, same format as this, that are going to be focused on growth. Take a look at this card over here. Go check that one out and watch that video. Appreciate your time and attention. Hope you have a great rest of your day. Take care.